Welcome to Mathematical Finance. Today we are going to explore a fascinating and counterintuitive trading strategy known as short selling. Normally, investors buy low and sell high. But what if you could sell high first and buy low later? Let us dive in and see how this works. To understand how we can sell something we do not own, imagine borrowing a rare comic book from a friend. You sell it for $100, expecting the hype to die down. A month later, the price drops to $60. You buy it back, return it to your friend, and keep the $40 difference. This is exactly how short selling works in financial markets. You are betting that the price of an asset will decrease over time. Now that we understand the basic idea, let us look at the formal mechanics. In the stock market, an investor borrows shares from a broker and immediately sells them. This puts cash in the investor's account but creates a legal obligation to return those exact shares in the future. When the investor eventually buys the shares back from the market to return them, this action is called covering the short. If the price has fallen, they buy them back for less than they sold them for, keeping the difference. Before we move on to the mathematics, let us see this process visually. This flowchart shows the complete life cycle of a short trade. We start on the left by borrowing shares, moving to the right as we sell them for cash. Then we wait. The crucial step is hoping the price drops. Finally, we buy the shares back at that lower price and follow the top loop to return them to the broker. The green dollar sign represents the profit made from the price difference. This visual process translates directly into a simple mathematical formula. The total profit, denoted by the Greek letter pi, is equal to the initial stock price, S0, minus the future stock price, ST. Conceptually, this is just the money you collected at the start minus the money you spent at the end. If the final price ST is smaller than the initial price S0, your profit is positive. But if the price goes up, your profit becomes negative, meaning you lose money. Now that we have our formula, let us apply it to a concrete example. Suppose an investor believes a stock is overvalued and short sells 100 shares. The current market price is $80 per share. First, we need to find the total cash received upfront. We multiply the $80 per share by the 100 shares sold. This gives us an initial revenue of $8,000. This cash sits in the brokerage account. But remember, the investor still owes the broker 100 shares. Continuing with our example, let us see what happens a month later. The stock price drops to $60 per share, exactly as the investor hoped. To cover the short, they must buy back the 100 shares at this new price. Multiplying 60 by 100 gives a buyback cost of $6,000. Finally, we subtract this cost from our initial revenue of $8,000. The result is a pure profit of $2,000. The investor successfully predicted the drop and profited without ever originally owning the asset. So, we have seen a simple, profitable trade, but we must make our model more realistic by introducing dividends. When you borrow shares, the original owner stops receiving dividend checks from the company because you sold their shares to someone else. Legally, as the short seller, you are required to pay any declared dividends out of your own pocket to the lender to make them whole. This extra cost reduces your overall profit, making it mathematically riskier to short stocks that pay high dividends. This brings us to our updated profit formula. We take our original equation and simply subtract a new term, D. This D represents the total dividends paid by the stock while you were holding the short position. Because this money comes directly out of your pocket to compensate the lender, it acts as a penalty to your trade. As the dividend D increases, your total profit pi decreases. You must account for this cash outflow when planning a short sale. Let us see how dividends and adverse price movements affect a trade in our second example. An investor short sells 50 shares of a company at $120 per share. We start by calculating the initial cash inflow. Multiplying the $120 by the 50 shares gives us a starting revenue of $6,000. At this exact moment, the trade looks great, but the obligation to return those 50 shares is hanging over the investor. Continuing the trade, things go wrong. The stock price rises to $135 per share. The investor decides to close the position to prevent further losses. Buying back the 50 shares at this higher price costs $6,750. Notice this is already more than the initial revenue. On top of this, the company declared a $2 dividend per share. Multiplying this by the 50 shares means the investor owes an additional $100 directly to the lender. Now we bring it all together to find the final answer. We use our expanded profit formula, substituting the values we just calculated. We take our $6,000 of initial revenue, subtract the $6,750 spent on the buyback, and finally subtract the $100 dividend penalty. The result is negative $850. The investor suffered a total financial loss of $850. This perfectly illustrates how rising prices and dividend obligations can destroy a short trade. This painful loss highlights a critical reality of short selling. Because a stock's price can theoretically rise to infinity, a short seller's potential losses are also infinite. Despite this extreme risk, short selling plays a crucial role in financial markets. It acts as a balancing force, preventing assets from becoming wildly overvalued by overly optimistic buyers. Furthermore, large investors use short selling for hedging, protecting their existing portfolios from sudden market crashes by offsetting potential losses with short sale profits. Let us summarize what we have learned today. Short selling is a powerful tool that allows traders to profit from falling prices by borrowing shares, selling them, and hoping to buy them back cheaper. We saw that the math is straightforward but must account for extra costs like dividend payments to the original lender. Finally, while short sellers provide essential balance and liquidity to the markets, the strategy carries theoretically infinite risk. You now have a solid mathematical understanding of short selling.